Hi everyone, Ashley Bishop here from Verse Wealth. I hope everyone is doing well and staying safe in these unusual times. I am one of the financial advisors here at Verse Wealth, and I am joined today by a very special guest, David Bassanese, who's the Chief Economist at BetaShares, which is an Australian fund manager. David, perhaps if you want to introduce yourself and tell us a bit about yourself.
Yeah, good to be with you, Ashley. Yeah, as I mentioned, I work at BetaShares. I'm the chief economist there. We're an ETF provider. I do top-down global macroeconomic research and offering just general information on what's going on in the markets and what are good investment opportunities via ETFs. So really, that's my role there at BetaShares.
Yeah, fantastic. And I think really important role and going to be really valuable for our clients to hear your views today, because we've got a few questions we're going to put to you, get your sense of where things are, and I'm sure we're going to have a really good conversation that a lot of our clients are going to really value. So with that said, the first question I have, and it's a fairly important one. Look, we've seen a big downturn at COVID, or during March in 2020, we saw 35% dips in Australia and internationally. Since then, we've seen a really strong recovery, not just here in Australia, where we've effectively regained all of our losses, in the US in particular, we're at record highs. So my question to you is, and a really important one for our clients as well, is, are markets overvalued, or are we still at a good point in terms of buying opportunities?
Look, on an outright, so-called price to earnings basis, I mean, markets are high, they're at highest levels in 20 years. But I mean, and you might see many, blogs and whatnot about people pointing out these high PE ratios around 20 times earnings. But again, relative to interest rates, and interest rates are just so incredibly low, the market, isn't that overvalued. If you look at it on a sort of earnings of the market versus bond yields, relativity, it's still well above long run average levels. And so that's the problem. Low interest rates have just pushed up valuations both in the equity market and in the housing market, obviously, as well. And that doesn't look like changing anytime soon. So to my mind, the market is it's not cheap, it's not expensive, it's reasonably valued. And these days, it's being driven by the earnings, the V-shaped recovery in both the global economy and the Australian economy. Strong growth in earnings is what's, driving markets at the moment.
Yeah, absolutely. I think that's a really valid point in terms of interest rates being at historic lows. And given that interest rates are so important in the financial markets at the moment, and in just general economic news as well, what are your thoughts about interest rates? Are they too low? Are they going to increase in the future? Where are you on this?
Look, at the moment, they're basically, in terms of long-term bond yields, my sort of 3 to 6 month view is that they're in a range. I mean, basically, we're at the point where, yes, the economies have rebounded strongly, but unemployment is still relatively high. It's taking a while to get back to tight labour markets, and central banks around the world basically want to see tight labour markets and wages growth going up before they even think about raising interest rates from what are incredibly low levels. And that's probably at least a year or so away. So we do have a situation where central banks are going to keep rates quite low, which is going to limit any upside pressure on bond yields, even with, strong economic rebound. And so that's a situation at the moment. They're low, but they're likely to stay pretty low until we get much tighter labour markets, which is still some time away. The backdrop here is underlying inflation in many countries is still, pretty low. Wages growth is very low, even though we've had a short run uptick in inflation in some countries due to, so-called supply chain bottlenecks, demand running ahead of supply as we rebound from COVID.
Yeah, absolutely. It's very challenging to maintain supply in the global markets when factories and businesses are shut down around the world for health reasons, obviously, but it does create short-term problems that we hope remain short-term. If we think about then interest rates, I mean, what do you feel like the impact will be if we do start to see interest rates rise in the coming years? What do you think the impact are going to be on share markets and property markets in particular? Because you touched on before that interest rates being so low are a big part of the reason that share markets are where they are and property prices are where they are. I mean, for our clients, we have this conversation regularly. If leaving money in the bank is not really worth it because interest rates are so low. That money is going to have to go somewhere, and it's gone to share markets and property markets. So if we start to see those rates rising in the next few years, what do you think the impact will be on share markets and the property market?
Look, in terms of the share market, I mean, historically, when central banks start to tighten policy, like the first stage of tightening from having cut rates during a recession, the markets pull back, so I wouldn't be surprised if we did get a correction in the markets once we start to worry about central banks tightening policy again. But again, this is a correction, it's maybe, 10% or so, who's to say, but it won't be a big, bad, bear market of the sort we saw, last year and during the GFC, for example. So a correction in the market out of tightening of policy is part and parcel of investing in the share market. So I think that will come, but it's not going to derail the expansion. The more concern for equity markets is when you get to sort of the end of the cycle where unemployment again is very, very low, wages growth is potentially picking up, and you get a recession. Particularly in the United States. And so that's still some time away. So that's the situation. So yeah, when and if, well, not if, I mean, I think bond yields will eventually go up, but again, they're going to go up moderately. They're going to go up by nowhere near, where they were historically. So they're still going to stay pretty low by long run average levels. Similarly for the property market, when they start raising rates in Australia, I mean, I think that'll probably see the market level off pretty quickly, if not before. And what we're seeing at the moment in the property market is house prices are rising because affordability, given so low, interest rates are so low, is actually pretty good. If you can get a house deposit or you can upgrade your property, mortgage affordability is pretty good. And that's causing prices to rise. When interest rates eventually rise, yeah, the market may flatten off, have a bit of a pullback, but again, it won't crash.
Yeah, absolutely. And that's a conversation I've had with a number of clients at the moment who are, whether it's the mum and dads who are thinking about gifting money to their children to help with the deposit, or the children themselves trying to build up those deposits or maybe even upgrade their home. The big concern is, well, are these levels of property prices, are they sustainable? Is there a crash coming? And what I often say to them is that, I mean, what is it that's going to change the conditions that we're in? Interest rate rises will be one of them, but you correctly pointed out, it's not. Rates aren't going to go from the 0.1% where they are now to 1% in the matter of 3 months. They're going to go to 0.25 and then 0.5, and it's going to be incredibly gradual. So I think you've made some really valid points there. In terms of, I guess, share markets, we go back to those because a lot of our clients have a good exposure to shares, as do many other Australians around the country. What are your views on, I guess, international shares versus Australian shares? Because in Australia, we hear about these Australian companies all the time. A lot of people have exposure to the ASX 200, so the top 200 companies in Australia on the stock exchange through an ETF such as, BetaShares. But what are your views in terms of where clients can potentially expect returns over the coming years between international and Australian?
Look, our market's done okay in the last few years, but I mean, for those that may not know, I mean, and look at global markets have actually done better than Australia for several years now. And the key driver there is that we're in a technology boom, a tech boom, like a disrupted boom. So the global technology companies, both in Asia, Baidu, Alibaba, Tencent, in the US, Google, Amazon, Facebook, these have been the companies that have really been driving markets almost since the GFC. And as a result, that's why global markets have tended to outperform. So we've done okay, but haven't done as well. So our technology sector, we do have a tech sector in the Australian market, but it's a pretty small share of the market. And so we've been held back by the banks and the resources. And so that's been the challenge for our markets. It's done okay, but globally, and I actually think, when the dust settles on COVID, the things that were doing well prior to COVID, i.e. technology in particular, will continue to do well because that's really the driver. So I'm more in a technology ongoing outperformance rather than, say, commodities, which is obviously a big important part of the Australian market. So I'm more in that camp. And as a result, I think global markets are going to tend to outperform the Australian market, going forward. So definitely have some exposure to Australia, but look at having, if you don't have any, some international exposure might be a useful thing to add to one's portfolio.
Absolutely. And yourselves at BetaShares, I've noticed in the last few months, you have tilted your portfolios a lot more towards international assets than Australian assets than perhaps you had previously. Is that really on the back of the expectation of, greater returns from international assets?
Yeah, look, it comes down to that sort of sector call. What sort of global drivers do we think are going to predominate over the next few years? Is it a commodity boom, as we saw from 2000 to, when China entered the World Trade Organization, you take a couple of decades ago, we had a commodity boom. Or is it an ongoing tech boom? And if it's that tech boom, then that's going to favor global markets. And that's sort of, I guess, underpinning how we've positioned the portfolios in terms of that global exposure.
Yeah, absolutely. If there's one thing we've learned down here in Melbourne and that you're currently learning up in Sydney is that technology is a very, very valuable thing to have when you're locked down in the middle of a pandemic. So look, no, thank you very much for your thoughts there, David. I really appreciate your time today. We're going to wrap up there. So hopefully things improve for yourself up in Sydney.
Thank you. I hope so too.
They do end. Lockdowns do end. But to everyone at home who's watching, thank you very much for your time. I really appreciate you watching this video with myself and David. We are going to be putting these videos out on a quarterly basis. So we'll be getting thoughts from David and others in future. So look out for those. They'll be coming into your inboxes. But that is it from us today. Stay safe out there. Look after yourselves and your family. Do the right thing. And hopefully we'll all be on the other side of this soon.